All right, well, welcome everyone and happy Wednesday. My name is Colin Evans and I'm part of the business development team here at Baird. On behalf of your Baird advisors, I want to thank you for joining us for today's Baird Wealth Strategies webinar entitled Maximizing Your Charitable Impact. As we kick off 2026, there's no better time to start thinking about how you can support the causes that matter most to you. We're excited to welcome Scott Grenier, Manager of Tax and Estate Planning, along with Kate Biaggi-Rickert, Charitable Solutions Officer from Baird Trust Company. Together, they'll share practical ideas to help you simplify your giving, amplify your impact, and advance the causes that are most meaningful to you. But before I turn this call over to Kate, I'd like to quickly review a few housekeeping items. All participants are currently in listen-only mode. However, we encourage you to engage by submitting questions throughout the session. You may submit questions by clicking the Q&A icon at the bottom right-hand corner of your screen. Please ensure your questions are directed to all panelists. Today's presentation is expected to run approximately 30 minutes, allowing ample time at the end for questions. If you have timely questions related to specific slides, we may address them periodically during the presentation. For your awareness, this presentation is being recorded and along with the slide deck will be available through your Baird financial advisor approximately 1 week after today's call. And with that, I will go ahead and turn it over to Kate.
Great. Thank you so much, Colin. I want to first start by saying that there's a previous webinar that Scott and I co-presented at in the fall that was a little bit more foundational and more detailed in some of these topics. So if you'd like additional information, please check out bairdwealth.com or reach out to your financial advisor. So thank you all for joining us today. We know that you're here because you're interested in charitable giving, and so we're happy to talk with you about this a little bit more, some different strategies and tools and ways that you can make an impact with your giving. So we know that for 2024, total giving was $595 billion per a study from the Lilly Family School of Philanthropy at Indiana University. Almost 90% of that was ultimately from individuals. As you can see, the breakdown in the chart, 392 billion came from individuals, then 110 billion from foundations. That's predominantly private foundations, which were started by individuals or families, and we'll talk a lot more about today. And then a lot came from bequests, which are from individuals' estate plans. And so again, you can see most of the giving came from individuals. You might be thinking about why you give, or it might be something that you've already thought about. People typically give because they have a belief in the cause. They might have a personal experience of giving back to their alma mater, to a hospital that benefited them, that kind of thing, or because their religion or their faith or their values encourage them to give. They also like to see the impact of their dollars at work while they're giving while they're living. As an added bonus for most charitable giving, there's potentially the opportunity to receive a current income tax deduction, and also the potential with certain giving tools to retain a stream of income back to you or other family members after making a charitable gift. And we'll talk more in detail as we go on. First, we would like to talk about some changes that happened with the One Big Beautiful Bill that was implemented in July of 2025. There were some changes that have started as of January 1st of this year. There continues to be a trend away from donors or individuals itemizing because of the higher standard deduction, which is at $16,100 for singles and double that for married filing jointly. So about 90% of taxpayers are taking the standard deduction. So that leads to one of the first benefits that came from OBA was the additional charitable deduction of $1,000 per person of cash gifts that are available to taxpayers taking the standard deduction. We saw something similar at a lower level during 2020 and 2021 during COVID. And so now for non-itemizers that are taking the standard deduction, that first $1,000 that they give away to charitable organizations via cash, they are able to get a charitable deduction. There's also now a 0.5% AGI floor for charitable deductions for taxpayers that do itemize. So for example, let's say you have a couple with a $500,000 AGI, then donations that they're giving above that first $2,500 are deductible, but that first 2,500 is the floor and is no longer deductible. Additionally, the benefit of charitable deductions and all other deductions for taxpayers that are itemizing is capped at 35%. So for individuals that are in the highest 37% tax bracket, the deduction is only available at up to 35%. So for example, a $50,000 charitable donation, the deduction is capped at 35% or $47,297. Some of these changes are a great opportunity for taxpayers that itemize to use donor advised funds and to bunch their deductions in select years, for which we'll talk about. Let's go ahead, Scott.
Thanks, Kate. And obviously, anytime we're looking at the One Big Beautiful Bill Act and potential changes, we want to think about how they're impacting you on an individual basis, which oftentimes means we're looking at your tax situation. We're looking at your tax returns. We want to know where your current positioning is from a tax perspective, your philanthropic interest, where you align with a standard deduction and any other deductions that you have. So as Kate talked about some of these changes to charitable giving from a tax perspective, we then apply that to different strategies we're thinking of as we think about your particular situation. So I'm going to give you a couple of different strategies that come to mind here as we go through this. So let's talk about first the retirement account side. We'll go through then appreciated assets, donor advised funds, and private foundations. The first thing we'll focus on is what's called a qualified charitable distribution, otherwise known as a QCD. A QCD is the ability for you to take up to $111,000, which is an inflation adjusted number, out of your traditional IRA and give it directly to charity. You must be 70 and a half years old. Now, this isn't the year in which you turn 70 and a half. It is your actual age of 70 and a half. And then once you get to 73 and you're in your RMD phase, the distributions from these QCDs count towards your required minimum distributions. So for example, if my required minimum distribution is 50,000 in the year, I can do a QCD for 50,000 to meet my required minimum distribution amount and not have that count as income towards my adjusted gross income. Now I can still go up to that 111 number, even if my RMD amount is only 50,000. So I'm not capped at my RMD amount. I'm capped at the 111 amount. All right. So if my RMD should happen to be greater than 111,000, well, then I'm now capped at the 111,000 for the QCD. Should also know that a married couple, each spouse can contribute their 111,000. So it's not at the tax return level, it's the individual taxpayer. And again, the big benefit of these QCDs is they do not get added to your gross income. So when we're thinking about your Medicare premiums and what they call an IRMA, which is an income-related monthly adjustment amount to your Medicare premiums, utilizing a QCD can help keep your adjusted gross income lower and therefore potentially prevent you from moving into different layers of increased Medicare premiums, which usually happen 2 years after your tax return is filed. In addition, there is modified adjusted gross income phase outs of various deductions and credits that are out there. And again, allocating the QCD to the charity from the IRA keeps this amount that you provide through the QCD out of those calculations for modified adjusted gross income. Becomes a very important tool for us as we think about philanthropic giving for those clients that are in their 70 and a half or older and in that RMD phase, as we're looking at those planning opportunities on a year-by-year basis. Some other things to know about QCDs, these often come up all the time for us, which is a QCD cannot be allocated to a private foundation or a donor advised fund. Now, I know we have yet to talk about a private foundation or donor advised fund, so bear with us as we will walk through what those entities and structures look like from an account type and how they're used. We see a lot of these strategies used by our clients, but we'll come back to what those entities are. And the last thing I would note here is something that is very underutilized and very unknown in the industry, which is while a QCD cannot be allocated to a private foundation or a donor advised fund, a QCD can be allocated to what is called a designated fund, which is a type of a restricted fund. I come up with this to being the sibling of a donor advised fund or private foundation. It is the sibling that is underutilized, but is available for our clients that want to think about allocating their QCD. They have the charities in mind, but they don't want all of it to be paid out to the charity as a lump sum. They want the charities to receive it over a timeline. So typically a strategy here might be to allocate that up to $111,000 to a designated fund, identify a couple of different charities of your choice, and then determine either a percentage or dollar amount payout. As an example, I might choose ABC charity to receive 10% per year for 10 years, with the residual balance then being paid out at the end of the 10th year. Or if I have 111,000, I might do $11,000 per year until the account runs out. Now, during this period of time, which we would expect to be about a 10-year period, the assets in the account are still invested, so they can continue to appreciate or depreciate in market conditions, which is why the actual amount that will get to the charity in that final year could be more or could be less than the original 111,000. But a very good strategy for those that want to provide a charity, want something similar to a donor advised fund, but yet slightly different in its own makeup and composition, but allows for the payments to be made over time versus a single lump sum. Now let's take a look at this in the math side of the equation. So here we have a single taxpayer donor gifting $12,000 with no other deductions. In this case, the single taxpayer had an RMD of $87,000. Other taxable income from Social Security. They were taking the standard deduction, plus they were over age 65. Okay, so their total taxable income comes out to $99,000 for a federal tax of $16,000. Now, if you're wondering why this tax benefit to the charity here is $233, remember, let's go back to what Kate mentioned before under OBA. Taxpayers who use the standard deduction and give at least $1,000 of cash to a charity get to take a $1,000 deduction. Call that an above the line deduction that they're able to take. Because they still get the deduction, while the $12,000 could otherwise be an itemized deduction, it's not going to help because the client is still going to use that standard deduction. Remember, Kate said 90% of most taxpayers are leveraging the standard deduction. So there still is a tax benefit to this client under the new rules. Under the old rules, there would have been no tax benefit if they were not itemizing deductions. But now in 26, this $1,000 deduction line item for cash gifts becomes available to this taxpayer. If we look on the right-hand side now, we look at the optimization of planning with a QCD for the same client that wanted to give $12,000 in cash. Well, here you can see that their RMD amount went from $87,000 down to $75,000 because the QCD helped with fulfilling part of that RMD amount. Under the deductions, we have our same deductions, but you can see now our taxable income is lower, resulting in a tax benefit to the charity of $2,800. The difference here is roughly $2,500 of additional tax benefit to the client. And that is without looking at any additional results that might come from keeping their Medicare premiums lower and or other deductions that could have been available to the client. So again, as we think about these QCDs, we think about their benefit in how this is going to impact your tax return and then the strategy around how to give to those charities. Now let's switch from the retirement account side and let's move to the what we'll call the brokerage or retail or non-qualified account side. These are your investment accounts that are not in retirement accounts. In this scenario, what we want to compare is the giving of selling a stock and giving cash versus gifting the security. The first note I would make here is if you are going to gift securities, we always want to give securities that have appreciated in value and have been held long term. If they have depreciated, we'd be better off selling the stock and taking the capital loss, harvesting that loss, and then giving the cash. On the flip side, if we give us if the assets have appreciated, but they've been held less than 1 year, well, now all of a sudden our potential income tax deduction is limited to our cost basis versus the fair market value of the security. So when we're thinking about planning and we're looking at the portfolio, we're always looking for assets that have appreciated in value and have been held more than 1 year. So let's use this hypothetical example here to show what happens if a client was otherwise to sell the position first versus gifting the appreciated stock. Here we have the wages of our joint married couple along with capital gain recognition, right? In this case, we're assuming that the capital gains of selling a $10,000 stock, they had $2,000 of cost basis. They would sell a stock for $10,000 and have a capital gain of $8,000. They would ultimately then look to itemize their charitable contributions. And again, remember Kate at the beginning through OBA talked about this 0.5% ineligibility for being able to deduct that amount. And that's why this itemized deduction amount here is no longer this $10,000, it's slightly reduced. The client has some mortgage interest and state and local property taxes, resulting in a federal estate income tax, of $22,000. But if we took this same client, instead of gifting the cash after selling the stock, and we were to go ahead and see we have no capital gain recognition, our itemized deduction number is slightly higher. Mortgage interest and state and local taxes are the same, and we can see our federal income tax comes down to $20,892 for a tax benefit to the client of $1,200. This is $1,200 of tax savings just by gifting the highly appreciated stock that's been held more than 1 year versus selling the stock, paying the capital gains tax, and then gifting to the entity itself. Okay. Now, we talked about before that we hadn't yet covered this concept of private foundations and donor advised funds. A private foundation and a donor advised funds are similar yet very different to each other, but consider them to be very close relatives. A private foundation is the establishment of an entity that allows our clients to donate funds into this entity to be held for grant making at a future date and time. And the private foundation provides much greater flexibility on the types of grants that can be made and the control that the donor has over the foundation and the grants that get made from the foundation. And we'll come back to that a little bit more. A donor advised fund, on the other hand, is very similar, where it gets set up but this time with no cost to set up through a supporting organization. The account is held at that supporting organization, and there's an administration fee each year for that organization to hold that account on behalf of our clients, where the assets are invested and grants get made out by the original donor at a future time. In both of these scenarios, what our clients are typically looking for is the ability to make a contribution to a vehicle today, an account type today, with the intent of trying to grow those assets and make grants to their favorite charities over time, including throughout their entire lifetime or upon their passing, by creating potentially an endowment or by having other members within the family unit, typically, overseeing that account and making grants on behalf of the family name into the future. Again, allowing clients to get that potential charitable income tax deduction now, and then make their grants to charities in a future point in time. Spread out those distributions, allow the assets in this vehicle to continue to grow, and then make those grants during lifetime or at passing, or even allowing others to make those grants in the name of the family in the future. So that's what these accounts are typically designed for. Now let's get a little bit more granular as to what they allow. Remember, I just mentioned that private foundations have a little bit more flexibility than donor advised funds. And what I meant by that is when you see this chart right here, under awards and scholarships or grants to even individuals, those can be made by a private foundation. Yes, in a private foundation, the board of directors or the trustees get to choose the scholarship recipients. Within a donor advised fund, you don't get to choose the scholarship recipients, although you can set up the parameters of the scholarship. You can see here, payment of grant making expenses. Oftentimes for private foundations, you might be trying to market the private foundation and grow the private foundation assets by different programs. Think about charity events in which we see professional athletes. they're typically using their private foundation dollars for the expenses associated with the event in order to generate new assets for the foundation itself. But a donor advised fund, we're not able to leverage the donor advised fund for those expenses. On the other side, you can see on grant checks, the ability to hand deliver grants directly to the institutions. Again, can be done with a private foundation, cannot be done with a donor advised fund. And then full anonymity. This is one that is a little bit different. You can see the switch now that is in the benefit to the donor advised fund side. However, I will note that private foundations and donor advised funds can be used in conjunction with each other. What I mean by that is, if I have a donor advised fund and I want to make a grant to an institution, I can make a grant to that public charity without that public charity knowing that the money came from my donor advised fund. And while I cannot do that same thing with a private foundation, what could be done is to take the grant from the private foundation and move it into a donor advised fund. And then from that donor advised fund, make the grant to the public charity and retain anonymity through that process. So there is a connectivity between private foundations and donor advised funds that go more than just, I would set up one or the other. Sometimes they can be working in conjunction with each other. Now let's talk about a strategy we see oftentimes with our clients. I mentioned this before, that sometimes we might want to get the charitable income tax deduction now, but then we might want to grant the money out to the charities over a period of time. And we often think about this, we call it bunching of deductions. So you'll see on the far left, let's take our client scenario. And our client has some annual cash gifting that they're going to do of this $12,000 per year. In this scenario, the client's itemized deductions is the $12,000 plus the $14,000, which only gets to be $26,000. Well, the standard deduction the client is actually going to take instead, which is $32,000. And you can see the projected standard deduction amounts just increasing slightly. We don't know what these amounts will be in future years, but these are just estimates. But you can see in each of these scenarios that the client is not benefiting from the itemized charitable deductions of the $12,000. They're not getting the full benefit. They're getting a $1,000 deduction, again, as part of that One Big Beautiful Bill Act change for 26. They're getting the $1,000 benefit, but they're not benefiting from the other $11,000 they're giving to charity in that year, in any of those years. So if we flip that and we look over at the tax benefit on the right side, and instead we give all of our charitable contributions in 1 year, and let's say 2026, and we give this $36,000 this year, our total benefit in this case comes out to be $48,600. Now I know you're saying 36 plus 14 equals 50, not 48,600. But remember what Kate talked about before under the One Big Beautiful Bill Act is 0.5% of the contribution you give to charity is not deductible. So we had to reduce that 50,000 down to this 48,600. But you can see the tax benefit driven to the client is this 11,660, which on an every 3-year basis, if we followed this script, would provide almost $4,000 of tax savings to the client. And what we're doing is we don't make additional contributions to the charitable entity in years 2 or 3 in this scenario. We've only done it in the 1 year. So we bunched all of our deductions into 1 year, and then we're going to give to charity, presumably over that 3-year period. We might give $12,000 in year 1, we might give $12,000 in year 2, and we might grant the other $12,000 in year 3. So the granting of the amounts can still be the same, but bunching when we make the contribution to design to come out with the best tax benefit, we oftentimes are looking at this bunching of deductions concept. Again, this is very personal to you and your family. We have to understand your particular tax situation, which is why we're looking at your tax return, trying to figure out in the current year if everything is the same or different from the prior year. Leveraging the updated tax laws under OBA, and then working with you to strategize with your tax professional to determine the best outcomes. And Kate, I'm going to turn it over to you now to maybe go through some case studies.
Great. Thank you, Scott. Well, we had a question come in about, does Baird facilitate these different tools? And so for the Donor Advised Fund, your Baird financial advisor can talk with you about the different Donor Advised Fund sponsors that Baird partners with, that your advisor can work with in helping with the administration, helping to continue manage the investments, but using that Donor Advised Fund sponsor to help facilitate your giving if that's what you'd like to do. Baird Trust helps facilitate private foundations. So now I'm going to give a couple examples of how we've supported our different clients for their charitable giving goals through the administration that we offer. So the first example is a client who didn't have any children, which is the case of about 2/3 of our clients that name a private foundation as the beneficiary of their accounts and their estate. And so this client wanted to support the different theaters throughout their community. But instead of wanting to do lump sum gifts from the estate directly to the theaters, the client was worried about if that would be overwhelming of a large amount at one time to the theater, and was also worried that what if by the time the estate is ready to make these gifts, one of the theaters or more than one theater isn't in existence anymore. As we know, the arts community has been affected by different economic factors. And so she named Baird Trust as the trustee of a private foundation that will be funded through her estate, and then it will continue to support multiple different charitable theaters in her community in perpetuity with a distribution to each of those organizations. And should one or more of those organizations cease to exist, the donor could decide, do the remaining organizations continue and just get a bigger piece of the distributions, or in this example, the donor would like that Baird Trust works to find a similar organization, a different theater, potentially one providing youth education opportunities, to be the beneficiary of that portion of the annual distribution. So this was a great example of a client where we know their charitable intent. She'll be funding the private foundation with her estate, and her legacy will continue to live on in perpetuity with an annual gift to her favorite theater organizations that she liked to support during her lifetime. Another example that we have is a private foundation that was funded with the living donors, who are still alive in this case, and they wanted to start doing their giving during their lifetime and start engaging their second and third generation of their families at this time. So the donor has a successful business and wanted to give back, as they've benefited so much financially from their business, and they wanted to support their local community and their traditional values that they feel made the family successful. They have a very strong family relationship and want to encourage the family to give, but many in the next generation down have moved away. And so they're less tied back to the community where the founding donor is living. And so they added some guardrails to the private foundation where they want the children involved, but they want the organizations that are supported to be based back in the family's hometown region, and with certain parameters of the different causes that are supported. They're also now having us starting to work with the third generation with that family, and those grandchildren are between 12 and 25 years old, and we can start having those conversations regardless of the age about what it means to give back to the community and how to support those organizations. So in this case, the donor named Baird Trust as the trustee, and there are parameters around those distributions and where they will go. Future generations will be involved in decision making, and they're able to be compensated for their time. That's a difference, as Scott noted, from a donor advised fund, that the trustees or board of directors can be compensated for the time serving on the private foundation for reasonable compensation. And Baird Trust will help ensure that the founder's original purpose is honored. Another giving tool is a charitable remainder trust. This is something that Baird Trust can help support in partnership with your financial advisor. Charitable remainder trusts are tax advantageous, irrevocable trusts that have dual beneficiaries of a charitable organization and the donor or other loved ones in their family. So in this example, the donor or the grantor makes a gift into a charitable trust. The trust is invested for growth. Those appreciated assets can be sold without capital gains taxes. And again, the proceeds are reinvested. And during the donor's lifetime or a named loved one's lifetime, they will receive income back to them for a set period of years, up to 20 years, or for their lifetime. And then at the ending of the trust, 20 years or someone's passing, the balance of the trust goes to charity. And so that charity could be a private foundation, a donor advised fund, or a typical public charity. An example of how this works and how it can be a great opportunity is when there are closely held business assets, such as a family farm or closely held business, company stock, that can be a great opportunity to pass to a charitable remainder trust. As we said, it can diversify those assets from it all being invested in one company or one specific asset and be invested for growth. And so again, it pays back for the lifetime to the donor or their spouse, or could name children. And at least 10% at the beginning should be calculated to go to the charitable organization at the trust termination. We have simulations that calculate all those numbers. We don't expect you to have to do so, but a great benefit is that the tax is deferred until the assets are paid out, and the donor gets to claim an immediate tax deduction against their current income. As we said, it reduces the asset concentration risk by reinvesting in multiple different positions. An actual visual example you can see of those simulations that we can run is a trust that was funded initially at $2 million for a client age 75. We anticipate that the client will get 7% in payouts and income to the client for their life expectancy, in this example, for 10 years. And then we anticipate that the trust will grow at 7.5% annually. So you can see the initial gift of $2 million, the annual growth, the income, and then the distribution. I misspoke earlier. The distribution is what goes out to the client. So you see that first year, $140,000, and it grows every year, assuming that in this example that the portfolio continues to grow. And you see the remainder balance every year. And so in that 10th year, or when the donor passes away, the remainder balance goes to a charitable organization. And so you can see that the $2 million following this simulation is what more than $2 million would go back out to charity, while the donor also received annual income. And they received a current year deduction of $940,000. Again, the charitable beneficiary can be a private foundation, a donor advised fund, or a public charity. Charitable remainder trusts or charitable lead trust, which is somewhat similar, those are one opportunity where Baird Trust can help support our clients' different charitable needs. As I mentioned, we also manage private foundations, and so that can be a private foundation funded by the donor's estate, or it could be one that you as a client would like to start now, or perhaps your family already has a private foundation being invested elsewhere and you'd like to consider Baird Trust and the services that we offer. Our whole goal is to make it so the client gets to enjoy the joy of giving. And so you reach out and you say, send this check to this organization, or help me have a scholarship in my name and in my legacy. And we can do all those details. We do all the administration. We can do the tax return if we're named as trustee. We can coordinate all the requests that might come in from different foundations. We can be the public address of record to help provide a level of privacy for the donor. And so we can manage those private foundations or charitable trusts. And then we just like our clients to know that a third service that we offer is fiduciary and investment management services for nonprofits. And so there might be nonprofit organizations that you know that have investments, have an endowment, and Baird Trust can be a resource where we can manage those investments. And as a value add, they get to work with the Charitable Solutions team, of which I'm a member. And so we can help those nonprofits by being a resource, by providing educational seminars, somewhat like this one, to their donors, their plan giving prospects, and all of that, and help be that resource for those clients. Back to you, Scott.
Thanks, Kate. All right, let's now talk about your team of advisors. During today's presentation, we've talked a lot about your personal tax situation, your philanthropic goals and interest and how we help align to those goals. This is never done by the work of one individual. You have a team of advisors that we are constantly working with. And that oftentimes starts always with your financial advisor. Your financial advisor is your trusted advisor that is going to understand your tax situation, your estate and legacy goals, and philanthropic interest. So we expect that in working with your advisors, you'll work with your advisor to identify these charitable goals. We can discuss planning concepts and techniques that are there, and then ultimately work with your attorney and your tax advisor to determine what strategies to execute and when to execute them. With the attorney, we're oftentimes looking at potentially these establishment of maybe these entities, a private foundation, a donor advised fund, a charitable trust. With the tax advisor, we're looking at the income tax deduction. Are you itemizing your deductions? Are we taking the standard deduction? What type of tax benefit might be driven as a result of the contributions? We know that the charitable tax deduction is a nice benefit, and it's not why you give to charity. We know that your philanthropic causes are the reasons for giving, but we also want to be tax efficient in any time we're identifying strategies that you might want to execute. So to achieve your philanthropic interest, we are having our Baird advisors work with your other trusted advisors to ensure alignment and that we're all working together to meet your ultimate charitable goals. As we think about opportunities ahead, it is extremely rewarding to be able to give to charity during your lifetime or even at your passing. Again, we believe there's tax efficient ways that you can work with your team of advisors by starting with your Baird financial advisor. As we talked about, there's very many different ways of gifting to charities, whether it's direct to a charity, whether it is through a donor advised fund, private foundation, some type of trust, etc. And our Baird advisors are here to help you understand these options, to weigh out the complexity versus simplicity, the flexibility versus guarantees, the income tax deductions versus the potential estate tax deductions, and whatever else we might need to look at when it comes to identifying the most appropriate strategy for you and your family to achieve those goals. So as you move forward in the year and contemplate wealth transfer strategies to philanthropic causes, I would always tell you, never wait till the end of the year. We have many of our clients that wait to that period of time, and it becomes very challenging to meet all of those goals. Versus if we're thinking about it today and we can come up with a plan, it allows us a longer period of time to develop a more thoughtful plan by bringing in those other trusted partners. So with that, I think we'll close out from today just by saying thank you for taking the time. We do have maybe some questions here that we can go through and answer those. And so if you have additional questions, please reach out to us right now. Otherwise, always reach out to your Baird advisor, and they can always bring in a member of our teams to join as needed to answer some additional questions. We appreciate you attending today. And Kate, I see there's already a question on the reasonable compensation side for a private foundation.
Yes, thank you, Scott. I'm more than happy to take that. And so, as I said earlier, a private foundation is able to provide reasonable, that's literally the term that the IRS uses, reasonable compensation for a trustee or a board of director. And so what is considered reasonable is based on the time and the expertise provided of that individual. And so the individual, if they are reviewing grant applications, if they're doing a site visit to meet with a nonprofit that they're considering funding or that they have funded and want to see the impact of their charitable dollars, doing that site visit, doing any travel, all of that can be compensation or reimbursement in the travel case provided to the individual. It can also be a percent of the funds that are granted out. So we have a few different clients that it's now in the second generation, and the first generation wanted to encourage their children to spend time being involved in the foundation and wanted to encourage those charitable dollars getting out in the community. And so they said, I want to earmark that 12% of the charitable dollars that are awarded can then be provided as compensation to the advisory committee members within the family. And so in that case, there's a few advisory committee members, and so they share that 12% of, based on, let's say, $350,000 is given out every year, then an additional 12% of that number is split among the family. Instead of tracking their actual time spent, that's how they use that. And so another thing that is permitted with private foundations is that family members can be hired for professional services. That could be, if it's a large foundation, having an executive director, or it could be for additional professional services. And we can work with individuals who would like additional information on specific cases. That was a great question.
Great. Another question that came up, Kate, was related to the tax reporting of QCDs. And up until last year, the IRS did not have a code on the 1099-R for demonstrating that the client had completed a QCD. So the IRS has provided guidance, although it is not yet a requirement, for the custodians to enter this code on your 1099-R. I would implore all of you to take a look at the 1099-R information that you are providing to your tax professional for your 2025 tax returns, and make sure that they are aware of any QCDs you might have completed in 2025. A best practice for us is to provide you with a list of those QCDs to make sure that we know the QCDs that you've done, and make sure that you're providing that information to your tax professional. But at a minimum, check that 1099-R. That's going to show you your total distributions from your retirement account in the year, and make sure that your CPA, your tax professional, is aware of any QCDs that you've done, since it does not necessarily carry over to the tax reporting of the 1099-R.
Great.
All right. With that, Colin, it doesn't appear that we have any additional questions that have come in at this time. Again, we would just advise everyone participating today to reach out to their Baird advisor to learn more about the different strategies, techniques, concepts, and answer any additional questions that we may not have completed today.
All righty, perfect. Thank you, Scott. Thank you again, Kate and Scott, for sharing your insights, and thank you to everyone who joined us today. We hope you found the discussion valuable and a worthwhile use of your time. If we weren't able to address your question, or if you'd like additional information, please reach out to your Baird contact, who can connect you with the appropriate resources. For those of you who would like to revisit today's presentation or share it with others, the session was recorded and will be available in approximately 1 week. You can access the recording through your Baird financial advisor or by visiting bairdwealth.com. If you're not currently working with a Baird advisor and would like to explore that opportunity, you can find an advisor near you by clicking the Find a Financial Advisor button on our website. Thank you again for joining us, and we hope you have a wonderful rest of your afternoon.